I was listening to Cato podcast on Iceland, on capital controls in Iceland. And if you don't know Cato, they're a libertarian think tank, and all their stuff is very academic. Um, but so what I would so it was talking about capital restrictions, and it's very economic and all these kind of things. Um, but what I noticed was how investors essentially got completely screwed over. Foreign investors in Iceland got completely screwed over by what happened in Iceland, and I just wanted to share this cautionary tale to people that are thinking about investing abroad. This just give an example of some of the bad things that can happen. So basically, what happened in 2008, you had the global crisis, where the economy's all dipped. So prior to that, Iceland wanted to become they wanted to get into the international banking game, and they monetized their fishing rights. Iceland's industry is driven by fishing and free power and tourism. Those are their main three things. The free power is from the geothermic heat, whatever, and they can generate electricity, essentially for free. Not quite for free, but they don't have to burn solar. They don't have to burn fossil fuels and so on and so forth. So they have very cheap power in Iceland. Anyhow, so they made their fishing rights. They gave them values and they leveraged them, so on and so forth, to pull in investors. Now they were able to pull in a lot of investors because the banks were offering 5.5%, 5.25% return on the money that was invested there, which is extremely high for just investing in a bank. Think about the interest that you get at the bank. It's like 0.1%. If you're getting 0.5%, that's good. So a bunch of international people dumped money into Iceland. So much so that they said, I think $200 or $300 billion of capital was in their three largest banks. It was a lot of money. And keep in mind that Iceland is a country of a little over 300,000 people. So a little over 300,000 people, and you have hundreds of billions of dollars, many times your GDP dumped there. Okay. And so essentially, I think what the effect of that is when these investors are dumping that kind of money into Iceland, they're essentially buying high. Okay, so that's essentially what happens when you round all the edges and you try to understand these complicated banking. They essentially bought high. Okay, so then what happened was that the banks crashed, the world market crashed. Iceland is on the kroner. There's their currency, the krona. I can't remember kroner. And they had to devalue their currency to become more competitive. So they devalued their currency 30 to 40%. They're not on the euro. And incidentally, and they mentioned this in the podcast, if Greece was able to devalue their currency like this, they could potentially become more competitive and solve some of their economic problems. But because Greece is on the euro, and you can't just cut people's wages, and that's politically unfeasible, that they're not able to become competitive, and they're not able to solve their economic problems. Iceland basically, they devalued all of their assets a third or 40%, and that allowed them to become competitive again. So all the money that was in there was devalued by a third or 40%, 30 to 40%, just based on that devaluation. So the investors lost that, but that's kind of typical. You invest, sometimes you lose, and that kind of happens. Now, what Iceland did was, because they needed infusion of capital, or they needed the capital to stay, just like in the United States when we did the TARP, the Targeted Toxic Asset Relief Program. These banks need capital to stay in business, essentially. And so what Iceland did was they instituted capital controls during the crisis, which made it so essentially none of the capital could leave, none of the money could leave the country. They wouldn't allow the international investors to pull the money back. And that's understandable. That's against free market principles, but I can understand why they do it. They don't want to. They think that if they remove all the capital, then it'll crash their economy. So yeah, so they stop the capital. Now turn back. Now fast forward 8 years, and the government, they've had buyback. Capital exit agreements with the government. So these big investors, they agree to pay the government like 10% of their investment or whatever to allow them to leave. But even 8 years later, they still have these capital controls, meaning they can't move their money out of the country. And they've kind of given these big guys a final offer of basically a 35%. It's essentially a 35% tax to move their money out. So they'd have to give them another third of what they have left over to move their money out of the country. Now, what's inconsistent? There's two inconsistencies here. One, they're now allowing capital to come back in. So if the whole point is to keep capital from leaving, why are you letting capital come back in? So there's that inconsistency that the government has, the Icelandic government. And then the second one is that they let domestic people move capital out of Iceland, but not foreign investors. And that's not really very fair to the foreign investors. For example, so if you have a capital freeze where you're not allowing the money to move out of the country, if a rich Icelander, somebody who's successful, wants to buy a home in Italy, he can't do it because he would have to move his money out. Well, that's pulling capital out of the country. So when they had the capital freeze, you couldn't Icelanders couldn't buy foreign properties or whatever. I mean, they could buy goods that were shipped to Iceland, but they wouldn't be able to go abroad and spend their money, in a significant quantity. So it's unfair now because the government is allowing people in Iceland to move their money abroad to buy things, but they're not allowing internationals to bring it back and to bring their money back from Iceland. So when everything's said and done, the investors are going to lose, 50% of their money in Iceland, of the money that they put into Iceland. And I think that should be a caution to investors. And the thing is, this will have effects too. I mean, people are trying to buy into Iceland now, but the reason they're doing that is because they're buying low right now. So their economy has recovered a lot, but the investors bringing the money in are trying to buy low, take advantage of the power and the fishing rights. But people are going to be very cautious about investing in Iceland, and this is one reason why a lot of countries are depressed economically. You have a lot of third world countries is because of these kind of things, where basically if foreign investors with a lot of cash and extra money, and they want to make some investment, if they think the country could potentially take half of the money or more, all of the money, because of politics or just instability, why would they invest? So I mean, I would never invest in Iceland, especially after this incident. I mean, there's no way. And the thing too is, it's not, I think some people say, well, it's just the rich people that are losing their money. Well, no, I mean, if you have any money at all in a retirement account, if you're in the United States and you have any money at all in a retirement account, it's almost certain that you lost some money in Iceland, because when you have money in your retirement account, it's usually going to be in mutual funds, and the mutual funds diversify, and they diversify into all different things, one of which is investments in Iceland. So, I mean, everybody that has any money in the market lost some money in Iceland. Anyhow, so this is why I think free trade is important, so that investors are willing to move money into a country so that they can use the money to better their country, improve their economy, and then the investor can also make money. And this is just an example of why to be cautious when investing abroad and in places that you don't know. If you enjoyed that, please like and subscribe.